Hi, Diane again. We're continuing on with topic 3. So we're looking at business transactions. In this mini lecture we're going to look at the steps to analyse a business transaction. So in the previous mini lecture I talked about identifying the duality of the business transaction. And we know that this means that a business transaction affects at least 2 accounts. So step 1 in the steps to analyse a business transaction is to identify the duality. So we have to decide at least 2 accounts. So what 2 accounts are affected, or maybe more, depending on the transaction. So we identify the accounts involved. So is it inventory, cash, accounts payable, capital, etc. So that's our first step. We identify which accounts are affected by the transaction. The second step is we determine the classification. So are the accounts assets, liabilities, owner's equity, revenue or expense? So for these ones, you know from topic 1, assets are things that we own or have the right to use. Liabilities are things that we owe or have a commitment to pay in the future. Owner's equity is the amount of money that the owner has put into the business, or the residual interest of the owner in the business. Revenue is the income that is earned, and expenses are the costs incurred in earning the revenue. So we determine the classification of those accounts. For 3, we determine if the accounts increase or decrease. So if we receive cash, it'll be increasing. If we pay cash, it's decreasing. So we work out which way it's going. And step 4, determine the amounts of the increase or decrease for each account that is affected. So they are the 4 steps that are involved in analysing a business transaction. So let's have a look at some examples. Sorry, before we get to the examples, I'll give you a hint. If one of the accounts that are affected is cash, then it's usually easier to start with the cash part of it, because we know from our own cash what happens when cash increases or decreases. So if we receive cash, it means cash is increasing. If we pay cash, it means the cash is decreasing. So we analyse whether it is a cash receipt or a cash payment, and these are usually the easiest type of transactions to analyse. And this is because we all understand, and it's relatively easy to determine whether cash is increasing or decreasing. Okay, so let's have a look at a couple of transactions just to get the steps cemented. So for May the 1st, we're going to have capital contribution. So the transaction is the owner contributes $50,000 in cash to start a business. So step 1, identify the duality. So at least 2 accounts are affected, and for this transaction there are 2, and it's cash and capital. Step 2, determine the classification. So is it an asset, liability, owner's equity, revenue or expense? So what we have is cash is an asset, and capital is owner's equity. So we've now done step 2. Step 3, determine if the account increases or decreases. So here the owner is contributing the cash to the business, so cash is increasing. So it's an increase in cash and an increase in capital. Step 4, determine the amount of the increase or the decrease. So here we've only got 2 accounts, so cash is increasing by $50,000 and capital is increasing by $50,000. So they're the 4 steps, or the thought process that goes to analysing a transaction. And we can write that in terms of the accounting equation, assets are equal to liabilities plus owner's equity. So if we write this one into our accounting equation, we're going to increase cash $50,000 and increase owner's equity $50,000. So whatever we do to one side of the equation, we have to do to the other. The liabilities haven't changed. So it is a 0 because liabilities aren't affected by this transaction. Second transaction, on May the 3rd, we purchased an asset. So the firm purchases office equipment for $3,500 and pays by cash. So to go through the steps here, and we're going to combine them a little bit. The two accounts that are affected are cash, because we're paying cash, and office equipment. So this is within the one side of the accounting equation. We're swapping one asset for the other. So we're going to decrease the asset cash and increase the asset office furniture. So for the accounting equation, the effect on the accounting equation, it is on the same side of the accounting equation. So we're increasing one asset and decreasing the other. So if we put this into our accounting equation, it looks like this. It happens all on the asset side. We're decreasing our asset cash by $3,500 and increasing our office furniture by $3,500. So in effect, we're swapping one asset for the other. Let's have a look at another type of transaction. So on May the 4th, it's a revenue or income earned transaction. The firm sends an invoice for $3,000 for services provided. So in this case, the firm has done the work, but they haven't received any cash for doing the work. They're going to send out an invoice. So the customer now owes the firm $3,000 for the services provided. So we have an increase in our account debtors or accounts receivable, which is an asset, and an increase in our fees or service revenue account, which is an income account. And it's for the same amount. The increase in our accounts receivable is $3,000. Increase in the revenue on the other side is $3,000. Now remember that income or revenue is part of capital. It increases capital. So when we have a look at this, we can expand our accounting equation out. Assets are equal to liabilities plus owners plus equity plus revenue minus expenses. And the revenue minus expenses represents the net profit. Net profit overall increases equity. So therefore, revenue will increase owner's equity, expenses will decrease owner's equity. So to pop this one into our accounting equation, we're going to increase debtors by $3,000 and increase fees by $3,000. Okay, so that concludes part 3. In part 4, I'm going to do a worked example showing you how to use a transaction analysis table.